Hey everyone! Welcome to my channel. Investing can seem complicated, with all the jargon that gets thrown around. But it doesn't have to be. In this video, I'm going to explain some common investing terms and concepts in simple language that anyone can understand. Consider this video your ABCs of investing crash course. Let's get started. Asset allocation. Asset allocation refers to how you divide up and invest your money across different types of assets, like stocks, bonds and cash. Having a proper asset allocation helps reduce your portfolio's overall risk. Typically, the younger you are, the more heavily you want to weight your portfolio towards stocks, to take advantage of their higher growth potential. As you near retirement, you'll want to shift more towards bonds and cash to preserve capital. Rebalancing your portfolio from time to time helps maintain your target asset allocation. Bonds. When you purchase a bond, you are loaning money, generally to a company or government. In exchange, they agree to pay you interest on that loan amount. Bonds are typically considered less risky than stocks. Government bonds are backed by the government, while corporate bonds rely on the company's ability to repay that debt. The main bond risks are interest rate risk and default risk. Compounding. This is one of the investor's best friends. Compounding refers to the accumulating effect of your investment earnings generating even more earnings. For example, when stock dividends get reinvested to buy more shares, that expands your base amount that can throw off more dividends. The power of compounding really adds up over longer time periods. This is why starting to invest early can be so rewarding, even in small amounts. Dollar cost averaging. This investment strategy takes advantage of stock market volatility. Instead of investing all your money meant for a particular stock in one shot, you spread out and invest equal small amounts periodically, like monthly over time. This approach reduces the risk of investing everything at just the wrong time when prices are temporarily high. Taking a disciplined, incremental approach helps you smooth out pricing ups and downs. Equities. Equities refers to stocks owning shares of a company's earnings and assets. While bonds represent debt, with promised payments, stocks represent risk capital ownership with potential profits or losses. The upside comes from rising share prices and dividends. The downside comes from the inherent volatility of stock valuations rising and falling. Understanding this trade-off between upside potential and downside risk is fundamental to investing wisely in equities. Fee-only financial planner. These advisors charge only hourly fees or fixed project fees rather than commissions on investment or insurance products. This avoids any conflicts between selling you certain financial products just to generate commissions. Their loyalty is to your interests in developing sensible financial strategies, and they aren't pushing products that may not be ideal for your situation. Growth investing. This approach focuses on stocks that exhibit strong earnings momentum and potential price appreciation. Growth investors are willing to pay higher valuations today based on expected high growth rates generating big earnings in the future. Trading off higher risk for higher reward potential. Growth stocks represent companies in expansionary mode revolutionizing industries rather than paying dividends. Hedging. This refers to protective strategies for offsetting potential losses, usually by taking opposite positions. For example, if you own a stock, you could buy a protective put option at a lower strike price to limit downside if the share price falls. Another common hedge involves owning bonds to balance out the higher volatility of equities in a portfolio. When done right, hedging reduces risks from unforeseen price swings. Index funds. You'll often hear that most fund managers fail to beat market benchmarks over time once fees are factored in. Index funds solve this issue by tracking market indexes themselves rather than trying to outguess them. This passive approach performs in line with the market by design at much lower fees. Index funds appropriately broaden exposure for many investors rather than betting all on just a handful of stocks. Joint accounts. Married couples can own taxable investment accounts jointly. These useful accounts allow assets to transfer automatically to the surviving spouse without going through probate. Both spouses have equal access to the assets and account. The downside is creditors of one spouse can go after joint account assets. Also, both spouses are responsible for taxes on gains. Kick further. This creative crowdfunding platform lets investors partner with consumer brands placing inventory orders. Companies get needed capital to fund purchase orders without loans or giving up equity. Investors then get repaid over 6 months from the sale proceeds as inventory gets sold through normal retail channels. The products serve as loan collateral protecting investments from business risks. Returns range from 12–25% annually. Liabilities. In investing, your home and car loans as financial obligations are considered liabilities requiring interest payments steadily eroding net worth. As opposed to assets throwing off income and appreciating, liabilities do the opposite by weighing down balance sheets. The higher your liability payments and balances owed, the riskier taking on additional borrowing becomes. Always match liabilities to your reliable ability to meet those obligations. Modern portfolio theory. This investment framework models efficient ways to reduce overall market risk by combining lower correlated assets, chiefly stocks and bonds. The ideal mix recognizes stocks have higher growth but more volatility, while bonds offer steadier protection during stock downturns. Adjusting allocations between these asset classes focuses risk management on reduced portfolio fluctuations rather than avoiding losses in any one holding alone. NAV. NAV stands for net asset value. This amounts to an investment fund's per share price driven by the total value of securities held in the portfolio divided by the number of outstanding shares issued. Actively traded ETFs and mutual funds both have fluctuating NAVs reflecting underlying asset valuations changing from market pricing and trading activity determining what buyers are willing to pay for shares. Options trading. Rather than buying assets directly, options contracts instead provide rights to buy or sell at fixed prices during certain periods. Investors can speculate on price moves or hedge risks using options without needing full capital to control the actual securities involved. Option trades require accurately predicting timing, size and direction of price changes to yield potential profits. Learning technical and fundamental analysis helps better forecast trends. Prospectus. Investors should always first read a fund's prospectus documenting key details including investment objectives, principal strategies, major risks, fees, expenses, management and more to align with personal financial situations. Prospectuses help determine if a fund's characteristics match your needs rather than blindly picking based on past performance alone. Reviewing prospectuses is essential due diligence before making any investment. Quantitative analysis. In contrast to qualitative subjective assessments of investment prospects, quantitative analysis relies on math-based evaluation of hard metrics like financial ratios, growth trends, statistical modeling and computing price targets. This standardized, evidence-based approach allows easier comparison on an apples-to-apples basis. Quantitative techniques also inform automated algorithmic trading processes used by major financial institutions. Rebalancing. As markets fluctuate causing asset allocations to drift over time, rebalancing trades restore original portfolio weightings when certain assets become overbought. Rebalancing forces investors to systematically buy low and sell high around long-term targets rather than ride unsustainable speculative bubbles. Periodically rebalancing minimizes emotion-based decisions chasing performance alone which rarely succeeds long-term. Socially responsible investing. Also known as values-based or ethical investing, this approach screens potential investments on environmental, social and governance criteria important to certain investors alongside financial metrics. By directing capital toward more conscious corporations, SRI investors incentivize greater corporate accountability, aligning investments with personal principles around sustainability, justice, transparency and stakeholder impacts. Tax loss harvesting. This involves selectively realizing portfolio losses to offset recognized capital gains, lowering net taxes owed. For example, selling a stock, fund or ETF at a loss can balance out gains realized elsewhere in a portfolio. Just beware of violating wash sale rules when buying a substantially identical position within 30 days of taking the tax loss. Tax loss harvesting boosts after-tax returns when done properly. Conclusion. Alright, we're out of letters, so that wraps up this first video walking through some key investing terminology. I hope you found this overview helpful, demystifying some concepts you may have encountered during your financial education journey. Let me know in the comments what investing topics you would find most valuable for future videos. Don't forget to like and subscribe. Thanks for watching.